How can you avoid paying taxes on the sale of rental property? One of the major advantages of owning rental real estate is that there's a whole series of different tax advantages associated with owning rental real estate. You can take depreciation, which allows for you to kind of write off the value of the built environment on a given piece of land through time. And if in fact it ends up retaining value, then you have a built-in gain, but that of course might engender the need to be paying taxes. And so one of the additional major advantages of owning rental property is that you can do what's called a 1031 exchange. You have to have arranged it with a qualified intermediary ahead of time, but you're selling the property and then you have a limited period, 45 days, in which to identify replacement property. Now, that could just be the sale of a rental home and purchasing another rental home, or the selling of a commercial building and buying another commercial building. That's the kind of normal 1031 exchange. But what gets more interesting is that you can actually sell, as an example, a rented out home and turn around and buy a home that you would anticipate using off in the future, that you would rent out for a period of time and then convert to maybe a second home, maybe a new primary home, and then choose to use other proceeds into a transaction. It's called a DST, or Delaware Statutory Trust, in which you become a partial owner in a multifamily project or in an industrial property or some other type of commercial real estate. That way you're not actually managing that new real estate, but you're still using the 1031 process to avoid the taxes from the sale of the original rental property. It's not the easiest thing to kind of navigate, but it is a way in which you can change the character of owning one piece of property into some combination of different other types of property that can be very useful and valuable for the long range financial needs of you and your family.